So you've learned about Web3 and blockchain. You have an idea about how this technology might be used to solve some difficult problem. You've talked to some business people, some mentors, some coders. You do some market and competitive research. You draw down your savings or get a loan from family to get your idea off the ground. You get some traction that validates your thinking. Now you've got to turn your idea into a business. This is when you need capital. Going through the fundraising process can be exhausting, humbling, and demoralizing. It can also be exhilarating, give you essential feedback to help you refine your value proposition, your go-to-market strategy, and find your target audience. Finding funding can also allow you to build your business. Finding the right kind of funding can make your business impactful. I'm Doug Heintzman. I'm the Chief Catalyst at the Blockchain Research Institute. Welcome to W3B Talks, an ongoing exploration of the impact of Web3 and blockchain technologies on business, government, and society. In this episode, we're going to take a look at the essential role of capital in building a Web3 or blockchain business. And to help us talk through this topic, I am very pleased to be joined today by Aly Madhavji. Aly is the managing partner of the Blockchain Founders Fund, which invests in and venture builds top-tier startups. Aly is also a limited partner at Loyal VC and Draper Goren Holm. He's consulted with the UN on alleviating poverty and serves as the Senior Blockchain Fellow at INSEAD. He's been recognized as a Blockchain 100 global leader and has published 3 books. He's a mentor, advisor, and exactly the right kind of person to help us explore this very important topic. Welcome to the podcast, Aly. How are you?
I'm doing well. Thanks so much for having me, and I'm glad to be here.
Well, it's very kind of you to join us, and this is a topic that I've really wanted to, do an episode on for a very long time. I've been on both sides of the fundraising equation, and so I've done thousands of pitches, and I've listened to many pitches and tried to figure out of the many pitches, which ones are good investments and why. So I think this is a super important topic. But even before we kind of get into the nitty-gritty on this, why don't you share with us your journey about how you came in, how you arrived in the venture part of this particular business?
Absolutely, happy to. So, I think it's been quite the journey, right? So going back, I think just even from childhood, I think some of the things that were impacting me and sort of my family situation really play into why blockchain became sort of a central part of, even you could call it, my identity, right? And so take this industry, which is built on, essentially creating transparency and helping to level the playing field. It's something that, has impacted my family, being refugees from East Africa, right? And so being Canadian, growing up, under these sorts of circumstances, I think it's something that's always been, near and dear to my heart on how do we help level the playing field? How do we help create more transparent, a better future for people everywhere? And so when I came across this technology, very quickly went down the rabbit hole on it. And, I think Bitcoin was a start of changing so much, but there's so much more to this technology when you start looking at the potential that then came along with Ethereum. And then even when you look at things like NFTs, which I think oftentimes there's very big misconceptions, people think they're JPEGs and monkey images. And the way I look at it is it's a technology that's, the first way in human history to track ownership in a digital world, which is fundamentally, shifts the way that pretty much, in my opinion, how a lot of the world will work. And so back then so after getting involved in the space, decided to start going full time into the venture side in 2017 and started investing in a lot of companies from 2017 onwards in this space. I'd already been angel investing in a lot of other industries, before this. And it's been quite the journey. We're now at 110 startups. We raised a new $75 million fund last year and looking for incredible startups to continue to back.
So, because you've already kind of started on this topic, but I was just about to ask you, why is this a good place to invest in? And you kind of talked about how exciting it is. But if you put on your VC hat and you're you're asking you're asking yourself the question, looking for opportunities that are going to, deliver good returns. And I don't know what your thesis is, but maybe we can have a discussion about what your thesis is. So why don't we kind of grab those two topics, what your investment thesis is and why you think that this is a good part of the market to invest in.
Absolutely. So, I mean, the way I look at it is this industry fundamentally shifts, the way the world will work, right? And so when you think about multi-party trust issues and the inefficiency that comes along with this because of the need to have trust in a lot of systems, you got jurisdictional risk, other types of things that end up impacting the ability for commerce to happen or business to happen. And then you implement systems that are essentially trustless, and you can solve challenges, even around all sorts of things from escrow all throughout the entire spectrum of challenges that come up. Blockchain fundamentally allows us to create a more transparent and fair playing field. Then, like I was mentioning with NFTs, it's fundamentally shifts because, you go back 30 years ago, 40 years ago, how much time were we spending in the digital world? It would have been 0%, maybe 5%, depending on what devices you were using. Now if you were to ask, someone growing up in this day and age, they're probably going to say 50%, 60%, 70%. And that trend is not going to change, right? And so ownership's at the core of everything that we have in our societies in the physical world. And so it only makes sense in the digital world to be able to track ownership in the digital sense. And so this is actually fundamentally shifts everything. And it's going to be at the core of, we think, everything in the digital world. And then you look at other major problems in society, right? We've got, financial systems that we could say work effectively, but we've left out 1 billion people that are unbanked or underbanked, that don't have identities and that can't enter this system. And so there is some major fundamental issues that need to be solved. And blockchain actually allows us to do this in a way that I would say leapfrogs the existing system. Now, of course, there's protections in the existing system and certain things are the way that they are for reasons. And so we need to work with those and with those regulations, and maybe some of those regulations need to change. But I think we've got a technology that allows us to fundamentally shift, the way things work and not leave 1 billion people out of the system. Now, you asked about the thesis that we have. Now, we look at this actually quite differently. So we invest across the entire spectrum of the blockchain space, right? So this would be, what we call, companies that are servicing the crypto or blockchain industry or digital asset industry. We invest in companies that are, very crypto native. So let's call it, you got your DeFi and gaming and like other things that might be more crypto native. But we also invest in companies that are connecting into the real world. And these are going to be, what a lot of people might look at, Web 2.0 type companies or 2.5, but these are, businesses that are we're interacting with every single day, but we think that blockchain can give it a competitive advantage in our everyday world. And so there's a wide spectrum that we have. And so when we think about things from a thesis perspective, we actually go much deeper. And so we look at, and right now have 25 open sub-theses where we think there's major problems in the Web3 space and no market leader, or a beachhead for companies to use as an opportunity to build a very substantial business. But we go very granular because certain areas there are big incumbents and not a lot of room to say compete, but we need to go much deeper than say DeFi more generally and go into like what specific challenges in DeFi or what can be specifically enabled that creates opportunity. And that's what we're more interested in.
Okay, so it really sounds like there's two major areas, right? There's the, I know that I'm a blockchain company because I'm in the crypto space. And then there's the kind of the group companies say, I'm in the, pick something, the healthcare space or the energy space or the banking space. And this is a new technology that can deliver some sort of value in those traditional industries, and you participate in all of them.
Correct. So, but it's got to be very central to a competitive advantage if it's going to be on those traditional spaces.
So the thesis was really that Web3 and blockchain it has to be the driving technology that differentiates the solution from all the other potential solutions in the space.
Correct.
Okay. What part of the investment process or what in the company development stage do you invest in? And what is your focus area?
So we come quite early, right? So generally, because, I myself was a founder, my partner was a founder, we actually look at ourselves more as builders than as investors. Even though we invest in a lot of companies, we like rolling up our sleeves and supporting companies solve challenges. So we actually come in anywhere from pre-seed through to Series A. And we typically write checks from 200K to 5 million. And so we write very large follow-ons as well into companies, as we see them de-risking, as we see inflection points in the business, we can go and support them with additional capital and resources.
We used to call that the Valley of Death, where there's this little section in the investment cycles that has a lot of risk associated with it because the markets aren't very well defined. The competitive landscape isn't very well defined. It's not the case that you're scaling something up. It's a proving new technology. And the way as an investor, if you're participating in that space, there's a lot of risk, right? It's a big risk, big reward sort of space. So are you pursuing a portfolio approach to this, or do you do just really, really deep due diligence and try to pick winners?
I would call it both. And it's because we're also investing on a pretty broad spectrum across a lot of the industry. We do definitely have a fairly large portfolio approach. Having said that, we write what we would call fairly small checks initially. We get under the hood. We actually set project plans with our companies around marketing, operations, tech, finance on a week-to-week basis. We know what their milestones and goals are in the short, medium, and long term. And then we actually go and measure those and look at those. And all of our companies work on updates to investors. We actually want them to do it not just to us, but across all investors, all advisors. And then we look at doubling down with, substantial checks into follow-ons as we see either things de-risking or get to know the company even better.
Well, when I was doing the founders and doing the fundraising role, we always had to differentiate between what we called dumb money and smart money. But you were kind of just talking to this interesting point that there's different kinds of VCs out there. There's different kinds of money, and I always found myself in this dilemma where the more kind of activist, hands-on sort of VCs were potentially a bit of a problem because they always got in the way. They were always second guessing you, always handcuffing you when you just wanted to get stuff done. But on the other hand, a really interventionist, hands-on VC fund that is being very well run can bring you extraordinary wisdom and insight and access and have networks and potential clients they can introduce you to and add a lot of value to the company. And my assessment is that in the VC space, there are different kinds of companies that are basically, banks and make pretty cold assessments about what the short-term returns are. And it's all about returning to their shareholders. And another group that are much more kind of hands-on and are actually very interested in the business that's going on, how it's done, and actively trying to help them succeed. So I think you've told me you're kind of squarely in the second camp of those two groups. But how do you decide as a venture capitalist? How do you decide whether you're going to be a builder or whether you're going to be a financier?
I mean, it's a good question. And the way you sort of framed it, I think, was quite good. I would actually say that, value add VCs are kind of like that A+ range of what you'd want as an investor. But I'd probably argue that financier investors would be like a B+, A-. And then there's going to be investors that get in the way and sort of aren't helpful. And they're probably on your, C, D, E, F, or whatever you want to, put them on the grade count. Right. And so like it can actually be negative if someone's getting in your way. And so the way we look at it is like, we want to be the first place that a founder comes when they have a challenge. Right. So because we can help them not from an investor hat, but we're going to help them from let's roll up our sleeves and help you figure out how to solve this, right? And I can tell you firsthand, when I had, my startup, I would send updates every single week to our investors. And I would say, I need help with XYZ. I need intros to XYZ, and stuff that would take me probably 20, 30, 40 hours of research and networks to go get to somewhere that I need to get to. I would get the next day. And I would get, save 20, 30 hours just by getting the right people, getting the right insights, and getting the right customers. And so this can be very impactful if you have the right people on your side. I think especially in an industry that's still nascent, there's a lot of different things being built. You need to find people that, you don't want to reinvent the wheel on every tool. If there's something you can integrate, something you can do that's going to save you 3 months of development, 6 months of development, it's a lot more helpful to get that intro and that insight and then integrate that in rather than sort of reinvent the wheel. And so there's a lot of these types of things where I think we can come in and support our companies. That is very helpful.
Yeah, as once again, on the side of the equation that is fundraising, there are many situations you can run into where you just need the capital, right? And the first person that kind of gets it to you because you probably already knocked on 100 doors, you're kind of ecstatic. But if you find yourself in the lucky position of having a number of suitors, if you were on the side, the fundraising side of the equation, the startup side of the equation, what are the top, 2 or 3 questions that you would ask a VC in your interviewing them to see if they're good enough to be, your source of capital? What questions should those people ask?
Yeah, that's a great question, right? I think from the founder perspective, you want to know clear examples of where VCs have added value on specific companies if possible. I would ask for references, and go speak to some startups, right? Whether you can go reach out to startups directly or just ask them, right? Is it okay if I go reach out to a couple of startups or any startups you can intro me to from your portfolio? I think that's a great practice, right? It'll stand out on its own very quickly if you go ask a few startups and get insights. And you should be doing this about anything, right? I mean, whether that's an investor, whether that's even, early customers, things like that, you probably want to know that this is going to be smooth sailing and someone you can work with and that's collaborative and able to help, right? Especially because your first customers are going to be probably doing a lot of reference calls if it's a B2B business, probably talking to investors that are coming onto your cap table because investors like us are going to ask for, a reference call with your first customer as an example, right? Or a recent customer. So, I think it's very important to have these types of questions being asked from the founder perspective and even understanding, do they understand my business? Do I feel comfortable, already? For me as a founder, and we tell our founders this all the time, I mean, there should be some value added even before the investment. You should already be I can see how they can help. I can already see doors that they're opening or things that I didn't think about that they helped me think about that's going to help my business. And that already hasn't happened in the investment process. Probably something's wrong.
So you said I think that's fascinating. I think you're right, completely right on that. And I think that founders should approach the fundraising process as, not only being interviewed to see if you're worthy, but making sure that it's a good fit, that you find the right source of capital to help your business grow, and that you should ask for references and you should be, doing the at least one half of the interview. You said you had got into the space in 2017. That was pretty much at the height of the ICO craze. And a lot's happened since, right? We've had the ICO hype cycle. We've had the NFT hype cycle. We've had, the crypto Bitcoin sort of piece of it. We've had the rise and fall of some enterprise blockchain consortium initiatives and the rise of some others. And if you look at the last few years, the capital going into this space has gone from about 10.6 billion in the fourth quarter of 21 to 2.2 billion in the fourth quarter of 22 to 902 million in the fourth quarter of 23. So over the last 6 years that you've been in the capital part of this marketplace, the landscape has changed quite a bit. How would you describe or characterize the evolution of the market, and where do you think it goes next?
It's a very good question. I mean, the space has definitely moved in cycles. I moved full time into the space 16, 17, right? I was involved before that. But, when you look at, what's happening from a capital perspective, a lot of it does fall in line with what you've seen from a macro perspective and also what you've seen on a macro venture capital perspective, not just in the Web3 space. So let's go back a couple of years, right? About a year and a half, 2 years ago, you already had big drops in public market valuations for startups. So you had, take your SaaS businesses, forward revenue multiples would have been something like 30 to 35x even, at the peak, or 25x, depending on the types of businesses you were looking at. And, they came down to essentially 5x, right? So a pretty big drop, about an 80% drop in valuations. They've come back now between 5 and 10x in a lot of cases. Some obviously stronger businesses are higher. And so you've had a pretty drastic correction in valuation. So what actually happened, which was very interesting, is Series A, B, C investors onwards actually slowed down drastically investing in those stages because they couldn't see a clear path to exiting, because the companies that they invested in were higher multiples than like what the public markets were giving. So what all of these investors actually ended up doing was they actually became seed investors and pre-seed investors, because they couldn't go to their LPs and say, hey, we're not deploying anymore. They just took a big amount of capital and tried to move it into a space that required a much smaller amount of capital. So what you saw over the last, year or so, is you actually saw an increase in valuations in seed stage and pre-seed stage, but you saw a decrease in valuations on Series A onwards, which was very odd. And that sort of relates to lower multiples overall on exit. And so even for funds like us, we looked at this and we're like, a lot of these companies are very overvalued, and we're seeing, seed valuations that are in some ways like similar to what their, Series A valuations would be, even though they'd have to have so much progress. And that sort of increase, had come down quite a bit, or that delta or differential had come down a lot. Now, I would say over the last 90 days, you've now seen a pretty big correction in seed and pre-seed valuations that now starts to make a lot more sense. And you're actually starting to see a lot more activity in the space, at least for us firsthand in our portfolio. We're seeing a lot more companies close deals, close fundraising, a lot more interest, I think, at more reasonable valuation. So even though valuations come down, I think there's a lot more activity. And then that paired with what's going on, the crypto markets or digital asset markets, you're seeing, pretty big increases in say prices of Bitcoin, ETH, et cetera, sort of go down the chain. And so that's actually created a lot more excitement in the space, which is helping, I would say, one, more digital asset or crypto native companies raise. But what's interesting about this space always is this is even helping the B2B companies that have nothing to do with digital assets or Bitcoin, but more on just using the blockchain technology. It's actually creating a lot more interest in them as well, which is a good thing, right? So, it's been an interesting couple of years. It does move in waves. We think right now it's picking up a lot, and it's probably going to continue throughout 2024, and we see it as a pretty strong year. One key challenge to keep in mind on the space is it is difficult oftentimes to invest in a lot of these different types of assets, say like venture capital, a lot of different private equity, when risk-free rates are higher. So when risk-free rates are fairly high, you've got private credit and say bonds that are AAA, AA, single A, fairly low risk at 8 to 12%. It starts to become very difficult to invest in a lot of venture capital, private equity. But we're seeing a renewed interest right now. And this relates even to challenges not only on venture as a whole, but even take like DeFi, right? The amount of risk you need to take to get 8%, 10% with low risk just doesn't exist in DeFi. The risk level is quite high. Whereas in the real world, you can get 8 to 10% with fairly low risk. And so these are, I think, still big problems that exist on DeFi and part of the industry as a whole.
The other thing that's changed is, at least in my experience, is the process. I was doing fundraising and pitching a lot at the beginning of the pandemic, and I remember we had kind of planned out the fundraising round, and we had planned these, getting on airplanes and going and living in hotels and doing road shows and hitting various different major financial centers and doing, 4 or 5 meetings in a week maybe. And, boom, the pandemic hit, and, we still needed the capital. And 2 things happened. One was that all the people that had capital were being very conservative with it and doubling down on their existing investments to try to keep them alive. And the second thing was, obviously, we couldn't go and meet anyone. But we ended up in this situation where, instead of doing, 4 or 5 pitches in a week, we were doing, 10 pitches a day. And we were pitching to venture capital firms in every country you can imagine. So now, where have we, where have we come since then, and where do you think that part of the process goes from here? How does fundraising and finding that right match, finding the right source of capital, finding the right investments, what's the mechanism there that you think, how do we get here and where do we go from here?
Yeah, I think this is actually a very big positive for founders, right? How it's evolved, like you were saying, from a few years ago to now, I think it stays fairly digital, right? So you can now pitch and get investment without having to meet VCs in person. And it's actually pretty effective. I mean, there is still some flying around. I think conferences have been great, but it's not necessarily that you're meeting an investor as part of the due diligence and closing that investment. Oftentimes it's, you might be at some of these bigger events, you meet a number of investors, you have a bit of a relationship, they know you a little bit, but you might be raising a round a little bit later, they already know you, or someone that you've met before and spent time with and that can give you a bit of credibility, is an investor. They end up backing it. Other investors are comfortable with that and don't necessarily need to meet you in person now. So you're not flying to each investor in your round or a bigger investor in your round anymore. It might just be you've met one of them in person that's vouching for you and, that knows sort of your background and your pedigree. And then, that might be good enough. Oftentimes you're not actually flying and meeting any of them in person on your first round. And then you may meet them after that, and then you may get follow-ons even after that. Like, so you may be in an event, you might meet them in person, build more of a relationship. Your next round, they're leading your round or writing a big check into it, which is great. I think this is actually a huge bonus for founders. You can generally compress rounds more, I would say, if you do them effectively and do them in the right ways, because you can do a lot more of these conversations in a shorter amount of time.
That makes sense. And this is a related question, and it may be a complete rabbit hole, but this market, the digital enablement of the capital markets that are allowing for much greater volumes of information transfers between people looking for funding and people that have capital that are looking for investments. We've because the digital interaction has facilitated many, many more interactions and made the whole process, more efficient at some level. Much the same way that the labor market has also been largely digitized. I mean, if you're on LinkedIn and a notification pops up that says there's an interesting job for you, and you go and you look at it, and then it says, how would you like to compare yourself to the other 10,000 people that have applied to this job? Of course, the companies that are using these digital tools have access to a very large potential labor pool, which in theory is great, but processing that number of people and efficiently is problematic. And so a lot of them are using AI engines to kind of sort through all the various different resumes. And now people who are writing resumes are using prompt engineering to create resumes that are likely to be selected by the AI engines that are selecting them. So do you see any sort of similar, as you guys get lots and lots, like thousands and thousands of proposals coming into you, using automation tools to try to narrow it down to the 10 or 15 that you really want to look at?
Yeah, it's a really good question, and we've actually pondered this quite a bit. We've looked at this quite a bit. So typically we look at 400 to 600 companies every single month, and we operate actually quite different than other funds, almost any other fund that I've maybe come across. So at most funds, what would happen is the analysts would assess which companies to look at further. And actually in our firm, the partners look at every single deal. Okay. And this is actually, there's a key reason for this. And it's because in an industry that's so early, that has so much transformational change, it's very difficult, we think, for it not to be a partner to look at it. Because, if you were looking at, and there's some clear examples of this, right? We've started investing, for example, in blockchain and gaming in 2018. Nobody in the world had a thesis on blockchain gaming at the time. And so it would have been very easy to say, hey, this doesn't exist. We don't see why it makes sense, as an analyst that may not have seen sort of where this could go. And, looking at this, for example, from a partner perspective and having sort of, more experience, more sort of wealth and knowledge that we can draw on, we were able to say, hey, we think this actually changes everything. And that's why we got involved in that. We started investing in AI and blockchain in 19, right? Again, everyone thought this was crazy and didn't make sense. Like, sure, it's hot in 2023, but in 19, this was not a hot topic at all. Actually, people had interesting comments for us when we were looking at this and thought we were a little crazy. So, I think that this is part of the reason why as partners, we look at everything. But the challenge is we're not looking for the most aesthetically pleasing deck necessarily, or the most concise deck, necessarily at a pre-seed level, right? And so it becomes very difficult to get AI to look at terms on businesses where we oftentimes know the founders aren't going to know how to explain this in as little words as possible, or as concisely as possible at that stage yet. And so it actually is a little bit different, where I think at some point, AI will probably be there and can help us with this, especially if we're filtering all the data that we have, and we've got a ton of data around this. But I think right now, it's probably not going to be sufficient for the ways that we're looking, because it's not as simple as, hey, this deck is the most concise, or the words in here are the best way it's written. Like, it's not exactly like that.
Well, sure, but having been on the venture capital side of the equation as well, I personally admit to a significant bias that when a confident team can very concisely articulate a very compelling value proposition in a deck that is well structured, well composed, and well rehearsed, I tend to have a bias, or I tend to think that maybe these guys have a really good shot of executing this compared to the one beside. And it's always possible there's going to be a diamond in the rough that, it's a brilliant idea, but they're just not polished and haven't thought it fully through. But still, if you're dealing with a volume business, then don't you have to use some tools to try to get to the right answer as efficiently as possible, recognizing that you may leave some diamond in the rough out there unfound?
So I hear you. I think our job is to find diamonds in the rough, right? When you think about the odds and like what we're doing as an industry and like essentially what we're looking for. But I mean, the challenges, some of our best deals, honestly, like, I don't think the founders could explain it in under 30 minutes or an hour when we first met them. Right. And that's fascinating. But I think that's more of a pre-seed problem than if you're sort of looking at seed stage, that's usually sorted out. But then you're also looking at, valuations of maybe 3-4 times higher, right? Or 5 times higher, whatever. And so, there's a risk reward to that. But I think at pre-seed, especially, or in an industry where it's, you might be doing something that no one's done before in the world and it's pioneering on something, it's not necessarily like it's the most polished from an articulation for investors. It might be something that's like extremely tech heavy or innovative that hasn't been fully sort of polished in that way yet. And so I think it depends.
So if you're going to take that approach, which I think is highly commendable, it does suggest that your partners have to be more than your typical venture capital finance person, that they have to have a fair amount of domain and technical literacy and be pattern seekers or pattern finders. So how do you build your team of partners with the right skill set to be able to go after this early stage in this emergent space?
It's a great question. I mean, I think there's a couple of parts. I think one, those 25 open sub theses that I mentioned earlier, those are fluid. So they're always changing, but each partner actually oversees different ones that they're passionate about, that they want to learn about. And I think there's a big part about, as partners, and there's three of us, being hungry to just learn and not being the smartest people in the room. And then anyone that tells you their investors are the smartest people in the room is probably not looking at the right people, right? It's we're looking for founders that are smarter than us, that are deeper into certain topics than us, that we can learn from, right? It's almost the other way around. Like, sure, we can open up doors in certain respects, but we need them to be able to be the experts in certain domains that they're going and building businesses under, right? And so we're looking as well to learn from our founders. And I think it's a very big part, though, to have partners that want to learn, that are going deep and learning about these industries and like these sub-industries, and then relying on and understanding from different founders and then different experts in the industry on if certain things can make sense, and if that's a pathway to sort of go for an interesting opportunity and a beachhead, for example, to grow a business off of.
Now you've kind of come back to founders quite a bit, and of course at the seed stage that's exactly who you're dealing with. You also said that you write follow-on checks. And certainly in a lot of the situations I've been involved in, the founders are not necessarily the people that are best suited to scale the business, that there's different skill sets that are, more favored at different points of development. And there, of course, are those special founders that, are legend in the business world that take it from inception through to, unicorn. But certainly in my experience, and please correct me if I'm wrong in this, there often are different skill sets that founders have, especially if they're scientific founders, and the kinds of people that understand how to build teams and scale businesses. First of all, is that assessment realistically? And second of all, how do you handle that dynamic or that question as you're working with these your companies?
It is a really good question. I mean, the way that we look at it is we're backing founders, right? And we're backing companies quite early in that pre-seed and seed stage. And so we're generally looking at, for example, do we think this founding group and this current executive team can achieve all the milestones required to get to the next price round within 15 months? Like, that's actually a question that every partner answers on every single deal we do, right? And that allows us to assess and understand where do we think they can get to with the current team and resources. Then what we look at is, is there key executive hires or gaps that we're identifying that could be part of, the company, but we're not looking at necessarily, changing, management drastically when we're making an investment. We're looking at this and saying, do we think the current team can actually win? And then we'll sort of support them along the way to add other pieces. Like, say they need, a chief strategy officer, or, a head of tech that may become a future CTO, or certain things like this. We can help them along the way to find certain key pieces. But generally, we come in at the approach that we're backing founders, and we're basically building and trusting with them to continue to scale this business.
So how do you, another interesting question that kind of comes up once again from some personal experience, but how do you deal with pivots, right? I mean, every once in a while, you've got a great vision, you found some funding, you're building it out and you try it and something happens, right? Either the market shifts or it doesn't quite play out, or some new competitive alternative comes in that devalues what you were trying to do. But there are some really interesting adjacent marketplaces. One of them might be, some implementation of your technology that's a little more narrowly focused. And first of all, how do you feel about it? And second of all, how do you help people through the pivot process and all the emotions and the financials involved around changing the direction of the business?
Yes, it's a great question on the due diligence process. I mean, we've got about 90 different things that we look at when we go through our process internally, and things that, have been red flags, things we've learned over the years, and we've sort of culminated and created our own process around this. Now, at the end of the day, most VCs essentially are looking for one thing, including us, right? We're essentially trying to measure progress over time, which is how fast are you moving in as little time as possible. And that doesn't necessarily mean, your revenues are growing exponentially. You might be pre-revenue, but that means, from a development perspective, is this moving more effectively and fast, like faster than you'd expect in a very little amount of time? Are you hitting certain like clear development milestones? Are you hitting clear like beta launch timelines or like initial users and things that we can see around that? Are you able to solve challenges around churn and like the product not operating effectively, quicker, or, different aspects like this, right? And so these are very key things that we're looking at. There's a whole set of other things that we're looking at in terms of like, especially in this industry, we want to see very strong technical teams given, blockchain requires a very strong technical front, right? So that's going to be very critical. There's a number of other things that we're looking at, but that sort of gives you an idea, of what we value the most. Is we just want to see companies making very fast progress in as little time as possible and looking at different ways to measure that and different learnings that are happening along that path.
So how long does this process typically take these days, the whole funding cycle? So I decide to start my fundraising round. I start calling up my network and talking to the VCs I know and finding new ones. How long does that entire process take? And has that length of time changed over the last few years? And do you think it'll continue to change if it has?
Yeah, so it's a very good question. So going back, 21, industry was booming. This process could be a few weeks, right? And it would move very, very fast. Oftentimes it was basically some funds that weren't even doing due diligence, right? Because of how fast it had to move. Now, I would say that process has changed a lot over the last year and a half. Now, a lot of founders have been spending 6 months to 12 months of the year fundraising, which we think is a very big problem because we need founders focusing on product and revenues at the end of the day versus, fundraising all year round to try to just make ends meet. And so we think this is a big problem. Internally, our goal is very different. Even though we've seen a lot of the industry lengthen their due diligence processes, there's a lot less competition. So funds don't need to be as quick. They're now taking 2 months, 3 months, et cetera, to close deals. We actually target 21 days internally from a first point of contact to closing a deal.
Wow,
now,
21 days.
Yeah, so that is a very aggressive timeline on our front. But it's because we essentially also have, I'd say, a fairly organized process. We know exactly what we want to see along the way. And if the company can share those things with us in a timely manner, we can move pretty fast. The way we look at it is if we expect our founders to move fast, as VCs, we need to move fast, right? We need to match that sort of pace and timeline that we expect from our founders. We need to be able to deliver the same.
Respect the urgency. Yeah, that's very impressive that you can do it in 21 days. And I completely agree with you. Once again, from being on the fundraising side of the equation, the frustration of having to spend so much of your time on what is effectively non-productive work. I'm glad. Well, what do you think the biggest challenges are facing startups in the Web3 space these days?
It's a good question. I think there's a lot of very big challenges. Take, for example, when you're building in this industry, at least what we're seeing from talking to so many developers is half of the developers, not half, but a very big chunk, are essentially rebuilding the same things over and over and over again, right? And all of these companies. So as an example, like let's say that you're building and you need data sources into your product, then you're going to build APIs into each of the exchanges individually as an example, or into each of the different price movement players, different tools that are giving you different data sources. And so the challenge then is, these APIs, let's say as an example, you're integrated into 12 different exchanges, right? Then if every exchange updates their API once a year, which is not unreasonable, that means every single month you essentially need to update one of the 12 APIs. And so now you've got a full-time developer focusing on this. And then you got to worry about problems like, say you're building an institutional product, you need to worry about like redundancies because you need quality of product, like you need uptime, right? You can't have something go down and your entire product goes down. So you need to build basically redundancies into your product. And so all of these companies are building the same types of redundancies. So this ends up actually becoming a challenge from a development perspective. And we hear this from so many developers. So we recently invested in a company called Uniblock that's actually built a unified API. So you build in one API, they built all the others on their side. It's one click of a button to turn on basically any Web3 product that you'd want to integrate. And all of the redundancies built in to allow you to build institutional scale products. And like, we think these types of things are tremendously speeding up the industry. So that's an example of some of the challenges. So, and that's where dev tooling is very interesting, is, solving some of these development problems in the Web3 space that allow you to actually build things at scale and with the appropriate, say, like redundancy and like factors that are required for institutional grade products. Now, there's also a ton of other challenges that exist throughout the industry all throughout. And, we're backing companies across the board that are building really, really cool products in this space.
One of the big differentiating features of the Web3 world is its potential radical composability, that you don't have to build stuff from scratch, that you can assemble in a Lego-like configuration and deassemble and reconfigure and reoptimize. And because of that, get access to all the advantages of open innovation. So I think what you're saying is that people that are building startups, it's crazy for a whole bunch of companies in the same place to have to jump through all the same hoops when we should be finding better ways to compose these things. And in the example of the company that you guys are invested in, to create abstractions and bundle complexity so that it can be more easily leveraged. Is that what you're saying?
Yeah, exactly, right? And you're seeing this a lot at different parts of the different cycles and tooling pieces or components that developers are using. And so, yeah, like abstraction's another big one, which is a little bit different, but you're seeing an entire side around how do you abstract away wallets and the complexities of the crypto side. And that's a really interesting area as well. So there's a lot of really, really cool pieces that I think will unlock growth for the industry as a whole across the board.
So what are the most common reasons that startups succeed or fail? I mean, if you're looking at your portfolio, all the companies that you've been in, and I assume they're not all, unicorns, that some are middling and some don't work out. But if you had to kind of put your finger on, some small number of differentiators between those different archetypes, what would those be?
It's an interesting question, right? And we always look at this and we always have these discussions. I would say that there's a few key things, right? I think sometimes it's timing around, like they might be building something that's a little bit too early for the market that, it hasn't necessarily gotten there. Take, for example, I still think this is a very interesting market, but take, every single consumer in the Web3 space essentially has a problem around what happens to their assets when they die, right? Like it's going to be lost because they don't have will and trust solutions set up. And so this is a problem that impacts 100% of the consumer market. And it may just be early for that solution, as an example. Now, I think there's other aspects around being able to really figure out how to monetize something effectively if we come in sort of pre-monetization in certain cases. I think certain times it's how do you continue to optimize and figure out how to sell more effectively, scale more with a fairly lean team and not have to increase costs as much. Because I think right now what's very critical is how do you stay lean and still grow versus I would say 2 years ago it was less important to say stay lean. So I think that's a critical part. Sometimes or fairly often in this industry, you do see the technical side not keeping up and not being able to build as effectively of what's needed in the timelines that's required. And so you see these delayed development cycles that don't allow the other side to sell the product effectively. There's all sorts of things. You've got the standard ones like founder issues, et cetera. But there can be a lot of different reasons. But we think it's, overall, I think we've been pretty good at stamping out, a number of these issues quite early. And that's part of those, 90 different things that we're also looking at from a due diligence perspective and things we've just learned over the years.
Well, I think that's some pretty sage advice. Crunchbase says that there's 22,087 Web3 startups currently out there. If I want to be the 22,088th company out there, and I've got some brilliant idea, how do I find people like you? Where do I start?
Yeah, absolutely. There's a number of ways. You can reach out to anyone on our team or any of our partners on LinkedIn, Twitter, all sorts of other social media. You can go to our website, blockchainff.com, and you can actually share info with us directly. And that does get reviewed by a partner. Every single deal does. So that's, a great spot to also share information. I think it's also great for founders to cold outreach, different VCs and different partners, et cetera. At the end of the day, the worst thing I think you could do is not try and not reach out, right? And so I think it's important for founders to also show, that resiliency and that sort of determination to just go out there and figure it out and message on, LinkedIn, find someone that we know and ask for an intro. There's a lot of different ways, and it's not necessarily for us. I think we're probably easier to get a hold of than most funds, because you could just go to our website and we do review all of those. But I think requires some determination to get through to a lot of VCs, and that's something that we try to help with, right? So one of the cool things that we do compared to other funds is, if we are coming into the deal, we end up helping to compress that investment cycle, that fundraising cycle, and we actually go and help you to go close the rest of that round. So we actually have about 250 deal flow sharing groups with other VCs that we coordinate with pretty common and pretty effectively. We have 50 recurring calls a month with other VCs that we can help, share cool deals that we're backing with other funds. And so these types of things can help to speed up rounds as well once we come in.
Wow. Okay. So, and and correct me if I'm wrong, but you guys are based out of Singapore?
Correct.
And you personally are based out of Singapore?
Correct.
Singapore is a remarkably active Web3 center. Singapore, Zug, Switzerland, there's a bunch of these centers in the world that there's a lot of activity going on. Why do you think that is? And where are the most interesting kind of centers of both activity and of capital in the world in this space?
Yeah, I would say the US is still always a strong center of capital, right? And so I wouldn't count that out, even though there's, I'd say, mixed regulation and still some uncertainty. It's starting to get a little bit better, but I'd say, there's still a lot of opaqueness. I would say that, like you mentioned, Zug is a great spot. London's always great for capital, right? Singapore is great. Hong Kong's coming back a little bit, which is interesting because it hadn't sort of been there for the last couple of years as super relevant. And then I would say the Middle East is getting quite interesting as well. So Dubai has started to become quite a hub, at least for events, conferences. It also has a lot of different of the right people traveling in from New York and Dubai and Singapore, and so it's become sort of this melting pot of different investors, talent, etc. So I think that's also a pretty good spot these days.
Okay. Any other final thoughts for us? Any pearls of wisdom that we haven't covered that you think should be out there?
Yeah, I know it's been a really tough time for a lot of founders to raise in this market, and I would say most important things are, continue to build on the product. Go continue to, if you're getting users, getting revenues, like keep building on that and reach out to us, and other investors that, might be willing to come in despite, I would say, the venture capital industry being a little bit slower overall. And it's easy to find us. So reach out to us. We're happy to see if it's something that we can help you, to scale and get involved.
Well, thank you, Aly, for joining us today and for sharing your great insight and wisdom with us. And thank you all for joining us today in this episode of W3B Talks. You can find out more information about the Blockchain Founders Fund at blockchainff.com. You can also find out more information about this and many other topics at blockchainresearchinstitute.org. And while you're there, please consider subscribing to our newsletter. I'm your host, Doug Heitzman. We hope that you have enjoyed this episode and will join us on our next episode of W3B Talks. Thanks again, Aly.
Fantastic. Thanks so much.
Bye.